All right, 2022, what is happening? This real estate market is absolutely wild week to week. However, there is one indicator that looks very promising to me that interest rate hikes are likely going to come to an end in the very near term. Let's get into it. Hi, my name is Vas, and I'm a chartered professional accountant turned realtor that's built and invested right here in York Region, Toronto, and in secondary markets outside of the GTA. We're going to talk about the 5-year bond. I know, boring. Before your eyes roll over in the back of your head, just hear me out for 30 seconds to understand why this is important, and then we're going to get into what this all means. You're thinking to yourself, well, why do I care about bond yields? There's two reasons. Number one, fixed mortgage rates are indirectly based on the Government of Canada bonds, and most important of all is the 5-year bond rate. Second, inflation is the biggest determining factor on what the bond yield is actually going to be. High inflation, high bond yield. For some context, let's start with looking at the 5-year bond rate since the 2008 financial crisis. As you can see, it obviously dropped, and then we continue to work and operate in a low interest rate environment all the way up until 2020 when COVID came. Once COVID came, we had a massive drop again because of a lot of uncertainty. A lot of money was being printed out, and then slowly we started creeping back up, where we get right here, March of 2022, where we had a record hike in the shortest amount of time that happened during March. And this is what spooked a lot of the market because rate hikes of this nature are not common, and they were coming very quick. Now, when yields decrease, it typically means that there's a negative economic outlook, there's worse market conditions, and a potential recession. However, despite our currently high inflation, the negative outlook on the economy into the future is being priced in as the more important factor that supersedes inflation. If we look at 2022, March, where the hikes started happening, this is where we started peaking, and this is where a lot of the panic came in. This is when real estate started dropping. What's happened since is now we're on a steady decline. And I think this is because the market is pricing in massive recession risk into the future, and potentially that inflation may after all be transitory. In a prior video, I had mentioned that once we get a hold of inflation, we'll get a hold of interest rate hikes, and that's going to bring the floor to the real estate market, which is currently very uncertain. This might be coming a lot faster than I thought. I still think we're going to have a rate hike this coming up June, but after that, it's a big question mark. At the very least, it looks like we're going to be putting rate hikes on pause, or they're going to be much smaller, which I hope brings a lot more stability to the market. On the flip side of this entire thing is, obviously, if we're pricing in a recession or a potential other global risk, that is another issue that we have to deal with. But the good thing is, at the very least, we can hopefully take one variable, one that has the most impact on real estate, which is interest rates, and at least have that contained. There are many other risks that impact real estate, but interest rate risk is one of the biggest ones. Obviously, with a recession, we might enter into liquidity risk and credit risk, but that is all noise relative to where we stand right now with so many different things working into this market all at the same time, where nobody can really make sense of when the price floor is coming in and when we can transact with a little bit more confidence. If you found this video useful, please comment below, like, and subscribe. And if you have any questions specifically to this video, feel free to text or email me. I'm always happy to chat real estate. And until next time, see you later.